Hey, good morning, it's Owen Bigland. This is the Inside Edge video blog. Wanted to comment on an article that came out from Fitch Ratings about 2 weeks ago on the Vancouver housing market. They also talked about the Toronto market as well. And why I wanted to go through this is some of what I've always felt is a lot of misinformation out there, or information that is half truths, part true. They kind of spin it in a way, and then they also just talk about the plain obvious, which is what this article is about here. So let me go through it. This was an article, as I say, came out a couple weeks ago from Fitch Ratings, and it was on the overall Vancouver market. They had said that the market continues to be driven by strong demand, both by foreign buyers as well as local buyers, ultra low interest rates, which we know, and they also went on to say that this trend can't continue. It's pretty much unsustainable for the long term, and that eventually they're calling for a correction. And I had to laugh at that, like, gee, no kidding. If you've been watching my blog for the last 5 years or so, you know that I've been through so many market corrections over the last 30 years in Vancouver real estate, I've lost count. They're pretty much, we should get one every 3 years on average. We're overdue for the next one, for what I would call a run-of-the-mill correction. Calling for a correction from Fitch here in the Vancouver market over the next few years is like saying that I think we're going to get some rain this spring in Vancouver. It's pretty obvious. It also reminds me of an old Wall Street saying about what they call top callers. They're on, in the stock market a lot. These top callers, they're always out there. They're kind of like the boy who cried wolf. They're always out there saying that the market, the S&P 500, the Dow is peaked and the market is going to plummet here 10, 20, 30%. Sell all your stock, get out of the market, and then buy back in after the market's finished correcting. The old saying on Wall Street is top callers are never wrong. They're just early. And sometimes they're early by 5, 6, 7 years. I can remember top callers on the S&P 500 3 years ago, and the market's gone up another 50% since then. Same thing in the Vancouver market, of course. There was top callers back 5, 6, 7, 8 years ago. 15 years ago, I can remember. I can't remember when there wasn't a time when there was a bunch of top callers out there. But, the important thing to take away from this is, yes, folks, as I've been advocating here as a realtor, I'm a marketing specialist. I also represent buyers. I've always advocated to people to not time markets. Concentrate on the things you can concentrate on, as opposed to what's going on with the dark clouds that are always on the horizon. Focus on your savings rate. Focus on getting a down payment together and getting pre-qualified and buying that principal residence. Don't worry about what the day-to-day fluctuations of the market are. Eventually here, this year, next year, the year after that, we're going to get what I call a run-of-the-mill correction in Vancouver real estate. It could be anywhere from 5 to 20%. Who knows? Maybe it could be a little bit more. Look at those if they come as a buying opportunity. But if you buy today, you should have an 8 to 10 year holding period to ride out any short-term fluctuations, because they are always short-term. The market corrects 10%, maybe treads water for a year or two, and then goes back up and sets a new high plateau again. That's the way Vancouver real estate works. It's the way any real estate market works, and it's also the way the stock market works. If you don't believe me, get a 30-year or 40-year graph of Vancouver real estate. Get a 30 or 40-year graph of Los Angeles real estate. Get a 100-year graph of the New York Stock Exchange, or the S&P 500 or the Dow 30. Have a look at what the trend line is. There's always little short-term dips in there and corrections, and maybe it'll run flat for a few years and then it goes back up again. The reason it does that is because of inflation, demand. There's a number of factors that will always continue to be going up. But there's always going to be short-term fluctuations in there. The other thing with this Fitch thing that gripes me to no end, they often talk about, consumers' disposable income to debt. It's running, their annual income is versus their debt is at 168%. So they owe more money than they're earning every year. Another stat that everybody already knows about. The problem with this one, though, is they always include mortgage debt in there. And I've done lots of blogs on this in the past, the difference between good debt and bad debt. Mortgages are one of the few forms of good debt because you're buying an appreciating asset. You're also using leverage. provided that you do not overextend yourself. Don't read me the wrong way here. You always want to buy with a long-term horizon with real estate. You want to put down a healthy deposit. You also want to have a buffer there, a side fund for when the real estate or when the mortgage rates go up. And they are going to go up. They can't get any lower than they are now. So leave yourself a buffer there. And mortgage debt is one of the best things you can take on. It's how wealth is created. The bad part of debt, the bad debt, that the only thing they should include in this thing is things like credit card debt or car loans or student loans. When you're running 20% interest rate, compare that to a mortgage at 2.5. That is bad debt, and that should be the only thing you're considering as far as disposable income to debt levels. So one final thing I'll finish with here. It's spring 2017. I get a lot of people that will ask me about, Owen, I know you hold your properties for long periods of time. Do you ever sell anything? Have you ever sold a principal residence or an investment property? And yes, I have sold a few over the years. Not many. I have sold a principal residence over the last few years, or in the last 8 years anyways, and moved up the ladder and bought another property, which is what I always do. But there are lots of times when it makes sense to sell an investment property. I've had many clients over the years that might have a portfolio of 10 or 15 properties. They're managing them on their own. They're getting a little older. They're starting to travel more, and they just don't want to start reducing their portfolio a bit because of all the time it takes to manage it. When you start getting up to 6 or 7 properties, you're getting a call every month or so from one of your tenants about something. So they want to start getting rid of them or trimming back some of them. They've made a lot of money on it. They're getting ready to slow down a little bit, travel more, and that kind of thing. Principal residence, it's the same thing. If you're thinking about moving up the ladder from a condo to a detached house or to a townhouse, or maybe even downsizing, it can make sense a lot of times to sell that big house that you weren't utilizing. The kids are out of the home and they're not using the bedrooms. Take a pile of dough off the table and downsize to a condo or a townhouse and invest the rest of the money that you sold up, that you got from the house proceeds. So there's definitely lots of good times to sell a property. In my business too, the unfortunate part of it is a lot of times I'm dealing with personal things like divorce or separation or job loss. In those cases, sometimes you're forced to sell a property because of those situations. So there are times when it makes sense for sure. But my philosophy though with investment properties has always been to try and buy them and hold them for long periods of time. Let your tenant pay down your mortgage payment, your interest, your property taxes, and your maintenance fees, and just let that property ride. But there are good times and that make sense. The buying and selling window is continuously opening and closing in Vancouver. Right now we're in an ultra strong seller's market. So in some cases, some people might be thinking, well, we're looking to downsize or looking to maybe offload some of the work from our investment portfolio. Then hey, spring, summer 2017 might be a good time because it is a strong seller's market. That window eventually will close. It's been a strong seller's market now for 4 years. Eventually, it's going to shift into more of a balanced market and then go into a buyer's market. So the window for selling is always opening and closing. Right now, it's wide open. Eventually, it will close. So if you thought you might be looking to sell in the next year or year and a half, hey, it might be a good time to do an assessment of the property and maybe list it this spring or summer. I'm Owen Bigland. As always, thanks for watching. I'll see you next time.